Hi, everybody. Welcome to Friday. As always, looking forward to today's session. Grateful to see as many of you here as we have. Hopefully, we'll even get a few more coming in as we get things rolling. But in any event, grateful for the opportunity. Excited as always for Friday. And there's always a lot to talk about, those things happening in the market. And we certainly have some positions to review and take a look at. And so we'll be able to dive right in. Really quickly, just in terms of interacting with me during the session, feel free to use the chat window. I'll be paying attention to that throughout the course of the session, and we'll respond to comments and questions as you have them there. Really, just so that you can see exactly where that is, I'm putting in my email address. If you have questions, for me during the week in between these sessions, you can always reach me there. You can also message me directly through the Substack or the Discord platforms, whichever one that you are on. Okay, let's go ahead and dive straight into it and waste no time, shall we? As always, it's Friday. That means there are always options that are expiring, and that gives us lots of things to talk about in the marketplace. Here are the current list of trades that I have going on. The ones that do not have a result in the column are the ones that are still open. And so we do have a few to talk about. And we will start with the put sale on Lam Research that I placed at the beginning of this month. This was about a 2-week trade where I was able to sell the $73 strike price and bring in a little over 2% for about that 2-week period of time. So this was a nice trade. This is something that for those of you, if you are not as familiar with put selling or other income-driven strategies here, these strategies are not necessarily about trying to time the market. This is a system that is built around trying to identify value in current market conditions. In other words, I'm looking for stocks that I think offer a significant discount and the right combination of fundamental strength to go along with that value proposition. Lam Research fit into that nicely at the beginning of the month and offered a nice premium as well. I'm also using put selling as an opportunity to set the price of a stock that I may be willing to buy. And so as we are looking at these, remember that whatever strike price you may be using, if you're placing the same trade, is a price that you should be willing to own the stock at. Every single put sale that I place is run on that basis. That doesn't mean that I'm going to be buying the stock in every single case. If the stock finishes above the put selling price at expiration, then that option simply expires. It goes away. I hang on to the premium that I brought in. But I am using that to set an acceptable purchase price for the stock. And that's the premium I bring in is the return, the maximum return that I'm bringing in for that expectation. If I'm assigned and the stock goes up after that, then that can give me a little bit more. But under a normal result, which is that the option expires worthless, that usually means that my maximum possible profit, no matter how far the stock moves, is the total yield that I brought in, 2.05% in this case for LRCX. Okay, so with that backdrop in mind, I know for some of you that have been with the group for a little while, that is already known. But I want to take some time and try to make sure that we're talking about some of the basics of how the Rebel income system is built as well. Here is Lam Research right now. We can see that the stock has been rallying very nicely from an April low at around 58. When I placed the trade at the beginning of May, it was up in this neighborhood. And my strike price I sold at 73 was right about here. So we can see that the stock is well above that price. So what I said usually happens with most put selling trades is exactly what happened in this case, is the stock has rallied all the way up here to a peak at around 86. Even with it tapering back now to a current price at about 80.50, it would still have to drop by about another $7.50 in order for me to worry about it being a sign. So looks like that is not the case here. And this does beg the question, though. This is one of the reasons that I pointed out with put selling, that this is the maximum, the premium that you bring in is the maximum, uh, really the maximum possible result of the option trade itself. So I brought in $1.50 per share on this. I sold exactly one contract. That means that I'm controlling 100 shares. My total income and my total return, total benefit to my account was 150 bucks. Now, by comparison, if I bought 100 shares outright, when I did place this trade on the 7th, let's see where the stock was actually at on May 7th. Closed around 75. Now that means that at the peak up here near 86, if I bought this stock anywhere near 75, I'd be looking at a total gain of about $11. So I want to throw this out, and I would appreciate your comments in the chat to give me your opinion and your input on this. Did I miss the boat? Was this a smart trade to excuse me, to limit my total gain to that $1.50 per share and nothing more, when the stock had such positive momentum going for it? And we can see, even with the even though it's coming back since, I would still be looking at about a $5.50 gain if I still held the stock today. So why work with the put selling trade in a stock that clearly had a positive trend working for it and positive bullish momentum pushing the stock to new highs? What do you think? How would you answer that question to another friend who was following maybe a more momentum based trading strategy? Barry, thank you for your comment. Can't see the future, so the trade was still a good one at the time you made it. If you bought it back, you probably wouldn't make your money back. Okay. I could probably buy it now back at about 2 cents, right? Gib, love this. Love this. You made your goal, accept and relax. I love that. And that's actually, thank you. That to me is one of the core points of a solid investing strategy, right? Is understand the constraints and the limitations that your system operates within. Accept the things that it allows you to do, and accept the things that it does not. It's just like when you. Sorry, I thought it was a call. I missed the first couple minutes. No problem, Barry. I appreciate it. And yeah, you are right though. If this was a covered call and I bought it back, yeah, I would have to, so that I could hold on to the stock for longer, right? I would give back my premium and then some, to be sure. So I would just want to allow that trade to be called out. In that sense, Barry, you're 1,000,000% correct. So I totally agree with you there. But Gib, you're making a wonderful point, and understanding what your system gives you, as well as some of the constraints and limitations that it puts you under, are important. It's to kind of what Barry is also talking about. Let's say that I bought the stock for the sake of argument, at 75, right? And then I turned around and I was able to sell a covered call at 78. Barry, you can't go broke with any profit. That's also very, very true. That covered call trade that I'm throwing out there as an example would have a maximum $3 profit. And so when you are an income generator, one of the things that you have to when you are using options to sell to open, when you're taking the selling side of a transaction rather than the buying side, one of the responsibilities you have is to accept that your total upside is limited, at least in that trade. What we are trading in exchange for more upside is immediate income, as opposed to the hope of future gains, right? I talk about the low-hanging fruit of the market, and that is what option sellers are doing actively every time they place a trade. The for Lamb Research, the low-hanging fruit was right here. It was 73, and it was $1.50. And yeah, you're exactly right, Barry. We can't see the future. So what I knew was that I could get 2.05% for a trade that was going to last for about 2 weeks. On an annualized basis, that is extremely nice. Anytime you can be doing better than 4% per month when yields on bonds are about 5% per year, then you're doing okay. And so that's one of the things that you have to be willing to accept. And that means that for trades like LRCX, where the stock starts to show some of this really positive momentum that I'm alluding to, you just have to be willing to accept it and move on. Barry, I was closing some directional trades, made a quick profit on some overnight trades, and trading again with Jerry. Okay. If it's working. And that you have a basket of capital that you're using for different trading strategies that allows you to maintain some proper position sizing requirements in each bucket. I think that's awesome. Okay, so that was Lamb Research, and this is all things being equal. It looks like it's going to expire for me, and that means that the capital that I put in reserve for this $7,300 for one contract will come back to me once trade settlement happens. That does mean that I've got to wait until about Monday, Tuesday before the $7,300 I put in reserve is available. What about buying the option back? There's a couple of different elements to think about there, and I need to expand this out. Let's go to 24. There's a couple of different elements that you have to think about when you are especially if the stock has shown some of the kind of momentum that we're dealing with right now. So here is the $73 strike that I sold. And we can see there's an asking price here of 32 cents. Now, since I sold at $1.50, that means that I could just not even monkey around. And if I was okay with that 32 cents, I'd still be able to hang on to a majority of my premium. But one of the elements that this begs is how much activity there is going on in this right now. And so we can see there's no volume right now, a little bit of open interest. What this is telling me is that if I wanted to buy this back before expiration, before the close of the market today, I might be able to do it. Extrinsic value, this is what is left. Remember, there is no time value left except for whatever can be attributed to 2 cents for the next few hours. But that's really about it. Means if I put in this 32 cents on a buy to close basis, there's a chance I could get it. And if I was simply taking what the market is asking here, I might even get it quickly. But it's also more likely that I would have to wait for a little while before that would come through. There's also a chance that that trade wouldn't happen at all, in which case the option would still expire worthless, and then I would still have to wait the normal one or 2 days for trade settlement. The advantage of buying back is that the capital, the $7,300 I put in reserve, becomes available for me on a more rapid basis, and so I'm able to put it deploy it towards another trade more quickly, and I can leverage trading frequency. This is usually easier to do for a stock like LRCX that has shown some momentum. It's usually a little bit easier to do in the days and possibly a week before expiration. So kind of just depends on the situation. All right. Anybody else that was in LRCX, if you want to throw out some numbers for comparison purposes, then please feel free to do that. So, okay. In any event, this was a good trade for me. It gave me a nice result, 2% for 2 weeks on an annualized basis. 48, almost 50% on the capital that you've committed to that trade. That's an attractive result. Okay. Next one is a put sale that I placed last week on Pfizer. Now, in the interest of full disclosure, Pfizer is a stock I've been holding for a while. I brought it in at a much higher price than where it is at right now. Selling the 22.50 strike price, if you didn't already have shares in the stock, means that you were able to really set a very nice discount price for this company. The value proposition at 22 is really actually pretty nice. The fundamentals are also as solid as they need to be. This was also a trade that gave me about 2% for a 2-week period. This one expires, next week. So we'll see where this one lands ultimately, but let's check in and see where we're at on it right now. All right, a little bit closer to the strike price that I sold. This one hasn't seen as much momentum as LRCX did. It's tracing back the last couple of days as the market is starting to show a little bit of bearishness. We're getting a little bit of a top, which shouldn't be a surprise considering the size of the rally after the April panic. We need to see some a little bit of a correction here. Market's down around here as the Trump administration continues to rattle the tariff saber a little bit this morning. We'll see what comes of that, but this is in part normal profit taking, so it's not really too much of a concern. It is interesting to see. Here is my 20-day moving average, the yellow line, along with the blue 200-day moving average, all coming up towards support here. So we'll see if this provides some additional support for the markets, and maybe gives it a launching point to rally again and maybe extend this trend. But what that means for Pfizer is that it's been correcting a little bit as well. We are a week 2 expiration though, and it does look like just this stabilization of the last couple of days kind of lines up with some of the previous highs right here. So it looks like we have pretty solid support in the neighborhood of $23 for now. That could obviously be broken pretty quickly. Now this one raises a different question than Lamb Research did because of the proximity to the strike price that I sold. We're still a week from expiration, and the stock is above the strike price that I sold. So this is a still a net positive result, and a net kind of, for a lot of people who are selling put options, kind of a net ideal result. The nice thing about being a week from expiration is that it also offers an opportunity to evaluate the possibility of rolling the trade. Now, remember, for reference on this, I brought in 45 cents on this put sale. And so at the 22.50 strike price, I've got an asking price of 14 cents. I know some of the people in our group would be screaming at me, why aren't you rolling this right now? So 45 minus 14 means that if I were to buy this back, buy it to close, I'd be hanging on to 31 cents of my premium. That's actually a pretty nice result, especially with the stock still, or with the trade, I should say, still a week from expiration. And to be clear, 31 divided by 22.50, that's still about 1.37%. And that's on, let's see, excuse me, that's after only 9 days. So call it a week. So if you're able to do this, sorry, I needed 1.37. If you could do this every week, you're getting in the neighborhood of 65-70% on an annualized basis. So there is a case to be made to think about whether or not to roll this. Part of the thing that should determine that question is not only whether or not you can buy the option back for a majority of the premium that you brought in, and that is the case right now, but also what do you do with the capital next? So let's look ahead a little bit. If you're willing to roll forward, buy it back, hang on to that 31 cents, you could roll up to 23, go up one increment, and bring in 33 cents. That's a little under 1.5%, but then again, now that's again a 14-day trade in that case, and then see where the stock is and what happens in the next week. Maybe you have an opportunity to roll that as well. Here's 48 cents, 49, it just changed for 3 weeks. So now you're getting back up into getting up above 2% again for an additional 3 weeks roughly. Now there's no volume on this one, but with this level of open interest, that does imply that you should be able to get into this trade pretty easily if, excuse me, if all you did was put in, this is not a recommendation to buy or sell. I need to keep that coward's door swinging, obviously. But if you were to put in a sell to open using the bid price at 49 cents, you didn't try to set your own, you just went with that price, you would probably get it. You'd probably get it pretty quickly. There's enough open interest to give good liquidity on this contract. So that is interesting. Not saying what you should do. This is just something you could do if you wanted. Okay. Again, if if you're working with Pfizer at all, or if you have a different idea about what you could do with it, let's see the numbers. Certainly, the way that I trade is not the only way that there is to trade. That's why I like to show the opportunities that are available with rolling. What's the advantage of rolling? Well, instead of a 2-week trade, in the example that I just gave you with Pfizer, you could turn that into a 9-day trade. You shorten the time frame, and you're able to place another trade almost immediately. You increase the trading frequency, you have a higher number of trades, even if you're having to give away some of the premium you brought in on the initial put sale. What you're doing is you're compounding more quickly. And that typically is going to mean that you're going to make more money than I do. I take a little bit more passive approach with my trades. I'm actively accepting a little bit less premium because it's easier for me to work with in the context of my trading system and the other needs that I have. But for a lot of people in our group who do apply this rolling method, they've seen some pretty nice results. And so I do like to try to outline where some of those opportunities lie. You could even consider going out a little bit further if you're looking for a little bit more time. 56 at 23. If you wanted to stay with very, very short-term periods and you don't mind being a little bit aggressive, excuse me. If you don't mind being a little bit aggressive and betting on momentum, you can also consider maybe going one, possibly even if you want to be more aggressive, 2 strikes in the money to capture more premium. Now, the caveat to this is you're selling in the money, and that means technically the trade will be a little bit underwater. Now, if you see any positive movement from where the stock is now, and you've done that, you will have an opportunity. You almost certainly will have an opportunity to think about rolling more quickly and more frequently. And if the trend is working for you, say you're getting something happening like what is happening right now with Lam Research, you may have multiple opportunities to do that within even just the same week. A lot of some of the rollers that I've worked with and that we've had in this group will take that little bit. They take a little bit more aggressive approach, and they've been able to leverage the trading frequency to an even greater extent that way. What's the caveat? You should be ready and willing to accept a higher occurrence of losing trades, because if the momentum doesn't continue as you anticipate, you're going to stay underwater longer, and that's going to make it harder for the option to give you the result that you want. And that will almost certainly mean that you should plan to manage the trade more actively. If you see any kind of strong movement against the price that you've sold, the stock continues to drop very much further at all, you'll probably want to buy it back more. You'll buy it back more quickly and close the trade to limit the loss. So the people who've taken this more aggressive approach to rolling will also be a lot more active about trying to manage those trades proactively. They will also have a higher occurrence of losing trades. It's still, if we want to talk about probabilities, let me just let's talk about this for just a second and shift the narrative for just a moment. This is a sheet I keep to summarize my trades. It needs to be updated. It's been a little while since I reviewed it, but here's my probability right now. Is it around almost 99%? This is a very high probability that the trade is going to work out the way that I want. It doesn't always mean that the put option is going to expire. This is including expirations as well as occasions where I bought the stock where I was assigned the stock at the strike price I sold, and then was able to get out later with a covered call trade and realize a net positive result. So that's happened almost 99% of the time. If you're taking a more active approach to managing, you're rolling the way that we've been talking about, then the probability is probably going to come down. You're probably talking about 85 to 80%, which is still actually pretty amazing when you consider that most directional strategies, if they're considered very successful, if you're placing a winning trade 25 to 30% of the time. If you want to be more aggressive with your rolling strategy, as I was talking about, selling in the money options on the hope that you're going to get a little bit more positive momentum, that way you can take advantage of larger premiums, your probability is probably going to go down again. That's the trade-off. When you actively take on more risk, you should understand that the thing that you are probably sacrificing the most is probability. So in that case, your probability may be coming down to about 70%. But again, depending on what your preference is, what your tolerance is, and what to the point of what Gibb said earlier, what your goal is and how much you want to relax. What is your sleep test? Then that may be okay. So you figure out whatever is going to work for you. This is what works for me. 99% probability, and being kind of passive about passive is not exactly the right word for what I mean here, but I can't think of a better one at the moment. But accepting whatever is going to happen at expiration, whether I'm assigned or whether the option expires, accepting that is what gives me that 99% probability right now. And I feel pretty comfortable citing this number because I have been placing these trades now for almost 11 years. So, okay. Very perfect comment here. In the directional trades, I tend to lose more than I win. And that's typical for everybody, including the best and most sophisticated professionals. I've talked to a lot of them. They all say the same thing. Going to lose more than I win. But with the smaller trade sizes that you use, good conservative position sizing, I'm up almost 27% since I started in March. So position sizing is the big key, and limiting loss in those directional trades. Understand that you are going to have a higher occurrence of losing trades, and that really does mean that limiting the loss on every single one of those higher occurrences is something you have to be willing to commit to do. Losing streaks in directional trades happen. If you think about it, again, the historical studies, my own trading experience certainly confirms this. Historical studies show that directional trading is going to be wrong 70 to 75% of the time, maybe more. That means that out of every 10 trades, you're going to be right maybe 2 to 3 times. Every 100 trades, you're going to be right every maybe 25 to 30 times. Put that 100 trades in a larger perspective. Of 25 to 30 winning trades, you've got 70 to 75 losing trades spread out over time. I mean, sometimes they come one after the other, after the other, after the other. So you have consecutive cases. You'll have stretches where you are placing nothing but losing trades. And that's really difficult. I'll be honest with you, it's one of the reasons that I don't follow those strategies anymore. Not that I don't know how to be profitable with them, it's that it's hard to take those losing streaks. The majority of people, no matter how much they educate themselves about these strategies, don't have the emotional capacity to manage losses the way that they need to in these directional strategies. That's the main reason the vast majority of people never make money in the market. is because they don't know how to lose. They don't know how to minimize loss, and even if they've studied how to do it, they lack the emotional capacity to be able to carry it out consistently, time after time after time, over time. So yes, you can 100% be successful with these directional strategies, but the first focus always has to be managing risk, limiting loss. If you do that first, and you're willing to commit to that consistently over time, over the long period, over the long term, you'll be okay. All right, enough of that soapbox. But thank you, Barry. I appreciate you for sharing that. Your numbers are very, very consistent with what I've seen myself. So, okay. On the 30th, I also have a covered call on FCX coming up. Now, this is a material stock. This is a fertilizer company that I was assigned shares of at 40 here at the tail end of March. And it recovered a little bit, gave me a nice covered call here last week. Let's see where this is at now. Excuse me, this is not a material stock. This is a Freeport McMoran. This is a mining company. Sorry, got them wrong. I got my symbols crossed up. Barry, more about directional strategies here. I only trade about 150 to 250 per trade, but have made a lot of them. Yep. With some, I lose 100% of the investment, but I have gained over 100% on some winners. I have amount set aside for this, and that's exactly the point. I'm familiar with Jerry's strategies, and that's consistent with what he does. You're going to be placing very short-term trades over very short periods on a directional basis. Sometimes you're going to give back the entire trade. You're not going to make anything at all, and in fact, you'll lose the entire investment. But others, you'll have some 4-baggers, you'll have some 5-baggers along the way too. So some of the wins you will win big, and that's the point, is to try to limit the loss on the downside. There's multiple ways you can do that. Stop losses are one way. The other way is working with these very short expirations, where maybe you're not working with such large amounts. Not doing it with your IRA. Okay. Maybe it's your speculative bucket. I've had traders they'll call the rebel income trades their boring bucket, for lack of a better word, or their IRA bucket, whatever. This is their income bucket, right? The more conservative kinds of trades that they place, and then they'll have another smaller one where they'll do directional trading, and they call that the fun one. So boring, fun, whatever. I'm okay with boring. Boring makes me money. So, all right. So FCX here sitting at around $38 right now, tapered, and it's fallen back off of that high at around 40 when I was able to place the covered call. So we're still about a week from expiration on this. So this could still rally back up towards 40, 50, possibly call me out. I'll be honest, I'm not entirely confident about that. We've got resistance here from the 200-day moving average, even though it is leveling out. It's sitting at about 41. Resistance can come, it's an area, not a specific price. So if the stock does start to follow through on the positive momentum it has today and starts to rally back up towards 50, next resistance could be anywhere between 41 and maybe 40, 39 and a half. So we'll see. What if I had to try to guess right now, FCX, the covered call that I have on FCX will probably expire. I don't think it'll be above 40, 50 in a week, but I'm also okay with that. That doesn't bother me. I don't have to get called out. If it continues to show some momentum here, there may be another opportunity to sell a covered call. maybe around the same strike price, which is okay as well. The yield on this stock isn't huge, but it's enough. More important for me is stability, quality of the dividend. Payout is around 50%, which is okay. That introduces another concept I want to talk a little bit about. And that's being open to new information. I've been working with my rebel income style of trades, put sells, trying to focus on value for, like I said, almost 11 years now, and longer if you count the period that I spent forming the rules around rebel income before I started trading it publicly. I felt like I got a pretty good handle on some of the criteria that I use. The interesting thing is that the volatility that we saw in April. Thank you, Mr. Trump, both to the downside and the upside. Really, it impacted a lot of stocks in a lot of different ways. Some of them followed exactly the same pattern to their own bear market levels, and they've been rallying ever since. Others, it's beat up even more. Some of my food product stocks are still struggling right now, for example. As a result of that made me start thinking not only about the criteria that I've been using to identify fundamental strength, but also to think about some ways to try to refine some of the things that I've been doing. If you've been reading some of my posts in on Substack or on Discord, in the reports that I publish, as well as in the articles, then you've kind of seen where my thought process has been going. It has been trying to increase my ability to recognize fundamental strength. And to be fair, I'm talking about trying to split hairs a little bit, because I already am very comfortable with the criteria that I have been using for the last decade in terms of my ability to find high value, fundamentally strong stocks. So by trying to tighten it even more, I'm talking about becoming more selective and trying to differentiate good from even better, if that makes sense. I'm not going to say gooder because that'll make my wife mad. And not necessarily good from great. It's usually a small incremental increase, right? You have good, and then you have a little bit better, a little bit more good, as it were. One of the ways to do that is by thinking about the dividend and the quality of that dividend. And so there's a lot of different ways to measure the quality of a dividend. I've historically used the pattern of movement of a dividend, and let me show you what I mean. Here is Lear Corporation. This is the stock that I use for today's highlight, by the way. Here on Zacks, it's really easy to see what the pattern of dividend movement has been. Has it been increasing, decreasing? Has it been stagnating over time? All of these are clues that can tell you something about a dividend's quality. So here in 2020, hey, guess what? No surprise, Lear was cutting the dividend because they were trying to save capital. Cutting dividends aren't great, but a lot of it depends on context. When you see this, though, it should give you a reason to really dig into balance sheets and some of the reasons behind the cut. It's really easy to assume when a dividend is increasing that everything is awesome. Company is growing, profitability is increasing. A stable dividend is also generally, the short answer, the easy answer is to say that's also a good thing, because they're keeping it the same way as the stock price fluctuates. then you're going to have opportunities to leverage that stable dividend at different varying yields. All of that is technically true, but there's also another element, and that is the stability of that dividend. Not only what is the pattern of movement, but also the underlying stability of the company's business, their profitability, their their balance sheet, and its ability to sustain that dividend. Dividends are paid out from available cash, and that cash can either come from free cash flow, it can come from cash on the balance sheet, but it's one of the two. There are a couple of different types of measurements for that. You can, excuse me, we don't have the ratios here, but you can look at different payout ratios. A simple one is to compare earnings per share to the dividend per share, and I can do that here on this chart. If I have the dividend on the right hand side, so that's here. Then I can do earnings per share. Both of these are trailing 12-month numbers. So here is earnings per share, $12.55, versus dividend per share, 3.08. That gives me some easy math to do. So I divide 3.08, 0.08, divide by 12.55, and 24.5% is the payout ratio. In other words, they're using approximately 25% of their earnings to service their dividend. That's one way, and that's one quick. There's a lot of services that will provide this number for you. And I've used this as a reference in a number of cases over the last 11 years. The problem, and maybe problem isn't the right word here, but the one wrinkle to this is that earnings can be not always the best evaluation of a company's profitability. This is one of the reasons I prefer to lean on free cash flow when I'm doing my overall fundamental analysis. Well, that was actually kind of one of the things that I realized was if I prefer to use free cash flow as the primary measurement of overall profitability, why don't I apply that to my measuring the dividend quality? So this takes a little bit more time, which I'll be honest with you, this is probably the main reason I wasn't doing it much before. But here's free cash flow. Barry playing the NVDL drum again. That's awesome. This is an ETF tied to NVIDIA. Yeah. Made a put sale on NVDL again yesterday for a $50 strike. A little bit underwater right now. Brought in 75 cents, I should say, for a one-day trade. 1.5% for 1 day. Looks like you might be assigned the shares. But then again, if it stabilizes at all, there you'll have an opportunity with the covered call. So that's okay. All right. So here we have our free cash flow number, 477.9. Let me plug that into my calculator so that we have it. The next number that I need is the shares outstanding. I can get that here, 53.46. So I literally just divide my free cash flow by the shares outstanding. And my free cash flow per share, I'm going to go ahead and call it $8.94. Now I have the basis for comparing my dividend to my free cash flow. So the dividend was 3.08 divided by 8.94, and it's about 35%. So we have 25% of earnings, about 35% of free cash flow per share. It's a little higher on the free cash flow side, but still conservative. If it's below 50%, that's a pretty good benchmark. This is one of the things that I've started to do with my analysis to try to differentiate and identify not only the quality of the dividend, but if you start to see these ratios start to creep higher, then a lot of times that implies there may be some other problems. Maybe you need to dig a little bit deeper into the balance sheet and try to see what's going on, especially if you're starting to see some declines in things like free cash flow, available cash, liquidity, those kinds of things. You may be net income. You may be looking at situations where maybe the business is not doing as well as you think. And so this is a good way. This is a good way to start to peel back and find additional layers of information. Now, the beauty of all of this is that I'm doing this for you. If you're following the same trades, I'm not saying you have to trade the same way that I'm doing, but if you don't want to have to dig into this level of detail and you're willing to work with the same stocks that I'm working with, I'm going to be doing a lot of this for you. Because this is one of the ways that I'm trying to refine what I'm doing to try to reflect a better approach to managing the trades that I'm placing under current market conditions. I think that one of the answers to increased volatility and some of the other elements of risk that are out there right now is to try to tighten my focus on quality. Yeah, so that's. What do you think? Does this make sense? Is this helpful? Do you have questions about any of the elements that I've talked about? Go ahead and put your comments in the chat if you do, and I'm happy to answer them. All right. The only other trades we have on deck here are we already talked about SCX, so the only other one is this week's put sale, which I placed on Schlumberger. Kind of right there with Halliburton. This is a excuse me. This is an opportunity to leverage the energy sector a little bit. Selling the $34 strike. That I placed this trade on Wednesday, so I don't expect the stock was going to have moved very far, but for a 2-week trade, I was able to generate about 2.6% premium on this. So this was a nice trade. Let's take a look at where we're at on Schlumberger today. Okay. Again, selling the $34 strike. We're a little bit below that right now. And I was placing my put selling trade into a decline. On Tuesday, when I highlighted the trade, the stock was sitting right around here, around 34.50. And the bearish momentum has continued. So is it going to have support here in the $33 range? Maybe. That's what it looks like it's doing right now. If it gives it that stabilization level, then that will probably work out okay. But for now, bearish momentum is kind of carrying the day on this one. If I take assignment on this, it's okay. We're so near to this 52-week low that even if stabilization is around 31, I'll be okay with riding this one out. Sorry. Really quickly. Here's a dividend on this one. If I am assigned, the expiration on this is the 6th. So if I get assigned before the 6th, before the 4th, I should say, that's the ex-dividend date for the dividend, then I could still qualify for that dividend if the stock's momentum continues to move lower. More than likely, though, is that if I am assigned, it'll be on the 6th, which would mean that I missed that dividend payment. That's okay. This is another one where the dividend, this is a really quick benchmark. If you're using TradingView, by the way, this is one of the things I like about their platform, is I can get a very, very quick high-level view of their payout ratio. This is based on earnings per share relative to the dividend per share paid out. So that's the more simplistic review there, but that does provide a good visual cue. Okay. Well, we're running up against time now, so we're going to go ahead and call the session. But I do appreciate everybody's participation today, for being here and for your comments. As always, I hope you have a wonderful weekend and have some fun plans with people that you care about. Keep them safe. I hope everything. I hope you have a wonderful weekend, a wonderful week ahead. If anything does come up, if you have any questions that I can help with, please don't hesitate to let me know. If you have concerns, I've posted in the, and I mentioned this last week, had some concerns about some things on Discord, about people who are not who they claim to be. If you see some things like that, don't hesitate to let me know as they relate to Rebel Income. Reach out on Discord, reach out on Substack, or send me an email, rebelincomesystem@gmail.com. Thanks again, everyone. Have a great day.